When you're looking at buying a new piece of equipment in your business and expanding, buying vehicles or just new assets, should you pay cash for those new assets or should you borrow and finance in order to buy those new assets? And ultimately, what this is going to come down to is what's known as your average cost of capital. When a company goes out and buys something, it basically does it in one of two ways. It will either buy an asset in the form of an equity purchase or it will buy an asset in the form of a financing purchase. An equity purchase is you taking money out of your pocket, putting it in the business, using that money to then go out there and buy the asset. A finance purchase is just that. You're getting a loan to make the purchase. So, which one should you do for your business? Well, it depends on what your cost of capital is for either of those options. For example, let's say you're looking at making an investment of $100,000. If you're looking to go out there and get a loan for that $100,000, your cost of capital is very easy to determine because it's simply the interest rate on your debt. If they say your interest rate on a $100,000 loan is 10%, that's your cost of capital, 10%. But what's your cost of capital on an equity purchase? Well, this is where you need to consider something like opportunity cost. For example, you can take that $100,000, go invest it elsewhere in the stock market or real estate, and you can maybe make a 10% return. So therefore, you taking this $100,000 away from your investments and putting it into your business, your cost of the equity purchase is 10%. So that's how you compare the two. Now, another thing to also consider though, because this isn't all that black and white, is inflation. For example, let's just say that annual inflation is 5% to keep the math easy. Let's say on this $100,000 investment, you go to the bank and they say we'll give you a 15% interest rate on this loan. So technically your inflation adjusted interest rate on that loan is only 10%. The 15 minus inflation, your true cost of capital is only 10% on that loan. And then the alternative for an equity investment would be you taking that $100,000, going and putting it in the stock market and expecting a 10% annual return on that money. Well, if inflation is 5% a year, then your return on that stock market investment is actually only 5%. So the cost of you making an equity purchase in that event would actually be cheaper to take the money out of your own pocket versus financing it from a bank. So there are two main determinants in whether you should buy something with cash or you should finance something with a bank. What is the cost of capital related to that purchase for either option, going the finance route or an equity purchase? And then two, what is the expected inflation rate over the terms of either scenario? And in doing an analysis like that, you can kind of determine which option will be better for you and how you should buy that equipment.